Hello Sector Watchers, welcome to the show. This is the 170th episode of Sector Spotlight for Tuesday the 4th of April, and I'm recording this on Monday the 3rd after the close of the US markets. My name is Julius the Kempenaer and I am presenting to you from Amsterdam in the Netherlands. This is the first Tuesday of the month, which means that we will look at the completed monthly charts for March. And I will start with an overview of long-term trends in asset classes, including a look at the US dollar and Bitcoin, as well as the relationship between stocks and bonds. Then we move on to the sectors. First, a quick look at the monthly RRGs for sectors, where we can see which sectors are turning around their long-term relative trends. And then we look at the updated table with the price trends and the support and resistance levels for each sector that I'm watching every month, followed by an assessment of the long-term price trends for each individual sector. Ladies and gentlemen, this is Sector Spotlight. The monthly charts for asset classes. Let's kick off with the S&P 500. We're going to talk about the sectors later, but the S&P 500 stock market asset class stocks is actually doing pretty well. I think it actually reversed into an uptrend because you can see that this peak here in February, the peak was in February already, peaked above this one, and the fact that March peak was lower confirms that we have a higher high in place. And it's now a matter of, so there should be somewhere here a low in between. It's not very clearly visible, but it's definitely there because we have a higher high. So from a very basic, pragmatic, technical approach, higher highs and higher lows on a monthly time scale, the S&P is now back in an uptrend. Is it all full-fledged and, you know, the only way is up? Probably not. There's quite a bit of resistance on the upside to be visible. This is only one day of trading, so we better ignore that. But there is a bit of resistance around 4,200, and then the more serious one is around 4,300. But nevertheless, S&P 500, things are starting to look better. If we go to the bond markets, then the image there is a little less fantastic. We've got the GOVT ETF here. That's the aggregate bond ETF that covers all segments on the yield curve. And what we can see here is that it's still trading well below that major support level, which is around 2410 in GOVT. And right now we're in this, I've marked it with sort of a rectangle. I think this is a very clear resistance area for the government bond market. And it's a lot better visible when we look at IEF. That's the 7 to 10 year segment on the yield curve. And you can see how important that 100 level was in the past and therefore can be expected to be very important going forward, and actually right now as we speak. There were two very important highs, resistance levels in 2008 and 2010 that we went above it, and then we had some major lows here in 2019 and again in 2018, and we hovered above it slightly in 2022, and then we broke it at the end of 2022. Dipped again at a very important level, 92. It shows up here in the past as two highs and another low, and then it worked as support again in October. And we're now pushing against that 100 level. Here in Sector Spotlight, we've been talking about the 100 level for IEF as being very important. And you can actually see on this monthly chart how important that level is. And last month, I should say, we actually failed to break higher. And so we've got a new chance in the month of April to do that. But it is a very important level. And if we don't break it, then yields remain elevated, because if this goes lower, it means that yields are going up, and that could be. I think we have to make that as a caveat, as something to be aware of when we look at the chart of the stock market. We got similar picture for other asset classes. So here is investment grade corporate bonds. You can see how we have that very important level around 112, 111, 112, just above 110, which worked magic over the last, this is almost 20 years, and every time that area between, let's roughly make it 110 and 112, shows up as either important resistance or as important support. Right now, it's expected to act as resistance. And we've seen that happening back in February. And, you know, we're right now, again, this is only one day of trading, but even if this month is going to be a good month for corporate bonds, that area between 110 and 112 will definitely start working as resistance. So we do need a real push to take that out and to improve this chart and basically bring LQD back into its trading range. Something similar is happening in high yield corporate bonds. A little less pronounced. They're a little they didn't make it back to that resistance area, just like LQD and IEF. So sellers actually came in at an earlier level, but it looks as if well, it is possible that we're putting in a new low here. It's way too early to tell yet, but the fact that the sellers came in here makes, I think, high yield the weakest, from a relative point of view, the weakest of LQD and IEF, because here the low is actually well below the expected resistance area. If we move to commodities, then we talked about that last month as well. That uptrend is now gone. We're still hovering above an important support level, but the momentum, the pace of that move that we saw basically from 2020 onwards is now gone. We should have seen a nice low against that trend line and then moving up again. Didn't happen. Kind of makes this uptrend void, and gotta wait and see what's happening now, what's going to happen into the next couple of months. But I think that there is plenty of resistance overhead. So here is this about 36 in DJP. We got that old support line that will eventually come back as resistance. So the upside's getting more and more difficult for DJP. Good news is that the downside's well protected around 30, 50. So my best guess for commodities will be sideways in the months ahead. Kind of a similar image you will see in GSG. Here also that trend line's broken. We're well above support, so that needs to hold up. But the momentum here is gone. So for commodities, both DJP and GSG, I think that the best that we can expect is a sideways move for now. When we move to the US dollar, then it is still hovering above or inside and above that very important support area between, let's say, 101 and 104. It's quite broad. This is a really long-term chart, and you can see how wide the swings are. But I hope you agree with me that this 100, 101 is an important level, and we got the spikes here coming in around 104, and right now, so this is the month of February. We dipped at 100.68, and then last month, so the month of March, we dipped at 101.56. So this is definitely important, an important area for the US dollar. If this holds, there is definitely, again, way more upside available. But keep in mind that when this gives way, when the US dollar index drops below 100 let's say below 100, that would be a really negative sign, and you could see a further decline, actually all the way back to the levels of 2021, which would be somewhere around 90. We're not there yet, but you got to keep it in mind because the longer we stay here, the bigger the risk. So ideally, in terms of strength for the US dollar, we would like to see this low to be intact, and from now on, the market to work its way higher to 106, 107, 108, etc. The other currency, so Bitcoin, as a proxy for cryptocurrencies as an asset class, that is pushing against a very important resistance area. That's around 29,000, 30,000. There's quite a few levels that you can mark if you really want to, but I'm going to keep it very rough. It's around the 29,000, 30,000 mark. And I hope you agree with me that you can see it right here, that we are pushing against that. This is the month of March. This is only one trading day. The turnaround is definitely there, but Bitcoin does need to take out that 30K area convincingly to actually make its way higher. If that happens, then all the way back up to 65 is definitely possible with some intermediate resistance levels around, this is 33,000, and probably more importantly here, 48,000. So watch that level around 30K. When that gives way in Bitcoin, I think that's definitely going to be a good sign. And the downside, and we do need shorter term charts, we'll talk about that next week probably, but around 25K is now support. That used to be an important resistance level. We took that out. That basically caused the jump to 28, 29, where we're working our way now. And that means that 25, which was resistance, has now become support. Let's have a quick look at the SPY IAF, so the stock bond ratio. That's still in a trading range. And as I said, that those bond markets probably have the key for this direction. Stocks seem to be on demand, getting better, at least from a higher level perspective. And you can see that they're still in that sideways range in the stock bond comparison. There is no clear preference at this moment for either stocks or bonds. If you look at the price charts, I think stocks have the preference because bonds have not been able to take out resistance. It's not yet visible in the ratio chart here. Let's start the segment for the monthly sector charts with the monthly RRG. And the interesting thing about monthly RRGs is that I've found out that it's probably, because this is looking at really long-term trends. So what we really ideally want to see on monthly RRGs are the turns when they are starting to turn around and change the RRG heading. Because if you really wait for a monthly tail to cross over or get into the leading quadrant or get into the lagging quadrant, you're probably very, very late. So I'm using monthly RRGs, the tails on monthly RRGs, to help me find turnaround situations. And if we look at the monthly RRG for the sectors, then it immediately is clear that the energy sector is in a big move rolling over. So that's a long-term turnaround. I think that's pretty clear, but what's also very clear is that it's kind of detached from all the other sectors. It's got the highest RS ratio rating. So that still remains a very strong sector, but it's going through a corrective phase, a very long corrective phase, and we got to take that into account. So if I toggle this one off and I fit the rest of the tails, then you got the image here that I think is the most important, it's the most telling. You got technology, discretionary, and communication services. These are the sectors that have been popping up in Sector Spotlight recently as being the stronger sectors in the S&P 500. And you can see how these tails have rotated back upwards over the last 3 to 4 months. And what also is happening, and what we've also indicated here on Sector Spotlight, is that utilities, staples, and healthcare have been rolling over. So these monthly charts are actually underscoring what we already noticed on those weekly charts, that money seems to be moving out of defensive into the more offensive sectors. Now in between we've got industrials. They're inside leading and they're moving to the right. There's not a high momentum move, but it's very stable. You can see how short this tail is compared to the other ones. You know, these are pretty, you know, on a monthly scale again, pretty strong moves, and you can see how industrials is a lot more stable. And the same goes for financials and materials. These are inside the weakening quadrant. And you can see how especially materials is, you know, how that is rotating around here. So there's no reason why this could not be moving back up again in the next couple of months. The one that's probably the most worrisome is the financials tail, because you can see how that has moved, and we all know why that is happening. So out of all these sectors, financials is probably the one that we need to keep an eye on most, because it'll either move into lagging or it will curl back up and start moving to leading. From this point of view, from this tail, it's very hard to say. So that is the rotation based on the monthly RRGs. Before moving to the individual charts for the individual monthly charts for the various sectors, I want to go over the table that we do every month. I've actually updated the weights because S&P and MSCI, who manage the GICS, the Global Industry Classification System, have rearranged. There's been a big rebalancing in the middle of March, and that had some effect on the weights of the various sectors. It wasn't major, but nevertheless enough to update it. So that's done in this column here. And I've updated most of the support and resistance levels. I could actually keep them as they were. So that means that during the month of March, there were some nice moves, but nothing really breaking out of major support and resistance levels. So if we go over the month-to-month results, then we can see that communication services was the strongest together with technology. Again, we saw that with the weekly tails of XLC and XLK moving into the leading quadrant over the last few weeks, so that's no surprise here. Financials with an almost -10 result was very clearly the worst sector. Again, we know why that happened. And interesting enough, the only sort of trend call that changed was the one for technology. And we'll see them on the individual charts in a minute. But the fact that technology is now in a new series of higher highs and higher lows, that was an interesting observation. You can also see that technology was the strongest based on relative, even stronger than communication services. And the S&P ended up 3.5%. With this move of technology going back into an uptrend, we now have about almost 31% of the S&P in a market cap of the S&P, I have to say, in an uptrend, and that's the energy sector and technology. And you know, energy was way over to the right on the RRG, still in a very strong uptrend, no doubt about it. So this is what it is for the individual sectors with the support and resistance levels. You can see them here. This is my reading for the S&P 500, and now we're going to look at some of the individual charts. Let's start with communication services. The higher low here is in place, but if we look at this trend here, this is still a downtrend. We're getting there, but we still need that, you know, that clear higher low to get into place and then taking out that previous high. And that would happen when the high of, this was February, around 19, let's say 200. When that's taken out, then I think that we can safely call that XLC communication services is back in an uptrend. If we go to consumer discretionary, one of the stronger sectors as we have seen. However, if you look at the long-term chart, this is still a downtrend. This low here is very clearly lower than the previous low. There is a possibility that last month was a higher low, but we do need to take out that in-between high, and that's not happening yet. So for the time being, consumer discretionary from a monthly perspective, still in a downtrend. Nevertheless, it's getting a lot better, and I could also live with, say, like this is sort of a trading range bottoming formation. But the way I label my trends, I have to still keep it in a downtrend. If we go to consumer staples, that is definitely in a sideways trend. You can see how we have that area above 800, just above 800 as resistance and around 700 as support. I've sort of shaded this channel here because it's really losing its value, I think. This is much more of becoming much more of a trading range right now. The energy sector definitely is still an uptrend. Actually, this is all-time high levels, so that's a very important area to watch. And I think that this is all, for me, this is all one big resistance area. You could even bring it right here around 680. So between 680 and 725. that is a very important resistance area, and you see how last couple of months we actually peaked here. Nevertheless, the rhythm of higher highs and higher lows is in place. So yeah, stay with it, and if we can take this out, then that will definitely be a good sign for the energy sector. If you look at the RRG and we see that tail rolling over and coming down, it might mean that we need a little bit more time in this trading range before we can actually start to push and pick up relative strength again. Financials is interesting, especially because of last month's move. That's obviously a big bar down, but as you can see, that support level, that old resistance that actually marked here the peak of 2007, and then here in 2018, and again here in 2020, and then it started to act as support back in June as well as October 2022, and it seems to have worked again last month. As long as we remain above that 500, 490, 500 area, support is still in play for financials, and we could actually see the market putting in a new low here and starting to move its way higher. It's still in a trading range, but this is an important level. If financials are breaking below, say 500, 490, 500, that would be a really weak sign for the financial sector. But with the weight of the financial sector, that would also be bad news for the S&P 500. So if we want to see that S&P 500 chart to continue to improve, I think that the S&P Financials Sector Index actually needs to stay above 500 and preferably start moving a little higher to actually support that move higher in the S&P 500. I think that this financial sector could have the key for further upside in the S&P 500. So we got the the bonds on an asset class level, and that's obviously tied in with the financial sector here within the various sectors in the S&P 500. So that what's happening in the bond market and what's happening here in the S&P financial sector, I think those are the things that you need to keep your eye on in the months ahead. If we look at healthcare, then that's still in a trading range. That's very clear. And that range is between 1450 and 1650. All in all, it's losing relative strength because the S&P is moving higher. That is very clear, and we've seen that before. Here is the industrial sector. That's also an interesting sector. As we saw, it's moving sideways on the RRG. You can see why that is. We're still labeling it as a sideways trend because the previous low was lower, but we may have seen a higher low here. We can't call that right now because that last bar here is only one bar of trading, but things are starting to improve. Mind you, that 900 area is an all-time high for the industrial sector. So if we can take that out, that will definitely be a strong improvement for the industrial sector. It's not the biggest sector in the S&P 500, but it's definitely going to help. So here is information technology. Here you can see how that, and that's probably better visible here. Here is your high, and here is your in-between low. I hope you can see it. But we do have a reversal to higher highs and higher lows for the technology sector. And that is the crucial part for flipping the trend in the S&P 500 higher. We're looking for resistance just below 2,700 in technology. We go to materials, and as we saw on the RRG, that tail is definitely worth looking for a reversal back up to leading. And you can see how here we have still a sideways range, but if we can take out 540, things can improve. The all-time high here is getting nearer, around 575, I think that's it. That's the area there. And then we have real estate, which is definitely one of the weaker sectors. You can see how that downtrend is fully intact. That is a very nice downtrend, lower highs, lower lows on a monthly scale. That's a serious downtrend. We do have a lot of support here between that 220, sorry, this is 205. Let me put the cursor here. That's about 205 and 210. But the upside is very limited, and we do have a little bit of downside present. And this is one of the few sectors that is still in a very, very clear downtrend on a monthly scale. And that is also in the lagging quadrant on the monthly RRG. And then finally, we have the utility sector. Again, one of the defensive sectors, moving sideways in a range between 320 and 370. As long as we stay there, the trend remains sideways. It's not going to have a massive impact on the S&P 500, but the fact that it's one of the defensive sectors and it's not really, really strong fits with the narrative that money is moving out of defense into more offensive sectors. And that wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. And of course, you can catch the replays and watch previous shows on the StockCharts YouTube channel or any of the on-demand channels. If you would like to engage in a conversation, you can do that in the comments under every video on YouTube or in the discuss section under every blog article. Alternatively, find @RRG Research on Twitter, Facebook or LinkedIn, or simply shoot me an email. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.